Aaron, if investors don't act before this breaks, my prediction is that their entire retirement savings are going to get annihilated. It's going to be the biggest, ugliest wealth transfer in history. When this annual report gets released, it could trigger the whole thing. The economy is propped up by a few AI stocks, and this thing could pop the whole bubble. If you own the wrong assets today, all bets are off. But this solution can weather any storm, Aaron, and I'm going to give you the full solution today.
Everything?
Absolutely everything. The names of the stocks, the position sizing, the entire strategy, how to execute it, the timing, everything. This has taken me decades to develop, and I'm going to give it all to you right now.
Welcome to the Porter & Company Black Label Podcast, your home for provocative insights that lead to lasting wealth. And here are your hosts, Porter Stansberry and Aaron Brabham.
All right, now let's get into it. We're back for another episode of the Porter & Co. Black Label Podcast. I'm Aaron Brabham. As always, I'm joined by our founder, 30-year industry veteran, multimillionaire investor, and of course, my old high school buddy, Porter Stansberry. Porter, it's good to see you again.
We're back. It is great to be here, Aaron. I do notice we seem to be missing something. Where are the gin and tonics? This is a Black Label show, right?
Well, it's probably smart. Longtime listeners will know that the last time we had a few drinks on air, we ended up causing a ruckus and losing you probably a few $100 million.
We got canceled at exactly the wrong time. But listen, speaking of causing a ruckus.
You've been making some bold calls lately, Porter, and you're prone to do that. And it has a lot of people worried.
Some things never change.
So today, we're doing a special edition podcast. Because, Porter, what you've been posting on X, it's pretty wild. Jimmy, can you pull up those tweets, please? So for the listeners who can't see these on screen, Porter, you're saying much of this bull market is a ruse, one that's propped up by just 7 companies high on their own AI supply, that the government is bankrupt, and that the dollar will lose half its value over the next 4 years. And not to mention that we're hurtling into what you're calling America's second civil war.
That's all right, Aaron. That's exactly what's happening.
This is apocalyptic stuff.
It is, of course, but it's important that everybody knows what's going on because it's going to affect all of this. You know, I've been saying for a while, and I think the reason why people are paying attention now is that all of a sudden, a lot of people are agreeing with me.
Funny, you're always what seems to be way too early. But you know who else agrees with you? Elon Musk. He's also posted about the dollar devaluation. Ray Dalio, of course. He's been warning about the debt crisis. And even Sam Altman, the poster boy of AI, is warning everybody about the bubble. Everything you warned about, Porter, is finally going mainstream.
It was always there. These problems have been there. Just, during the mania, people didn't want to hear about it. And of course, the people who were causing all these problems are never going to admit it. And Aaron, what we have seen again and again and again is when these crises hit an isolation, then, nobody really notices. When stock valuations get overstretched like they are now, we get 2000, we get 2008. When inflation runs wild, we get the 1970s. And when governments default on their obligations, we get the Weimar Republic. We get crazy inflation. But look, I've been a student of economics, history, and finance for 30 years, and I'm telling you, we have never seen anything like this. This is, hundreds of years collapse that's about to happen. Think, the sack of Rome. Think the collapse of Greece. Think the collapse of the British Empire in World War I. Even if you look at all those things, none of those great historical collapses all had all of the destructive forces converging at once.
All right, Porter, you're certain about where all this is heading?
Absolutely certain. The market concentration that's going on right now is unprecedented in history. The government math that doesn't work, unprecedented in history. And the inflation that's being systematically hidden, all of it unprecedented in American history. And look, when the public finally realizes what is actually going on, it's going to be fireworks. There is going to be massive unrest and violence. And that fuse is already lit. It's burning faster than 99% of people in America are prepared for or will probably even believe. And there's going to be an explosion soon because there's a document that gets filed by the government every single year, Aaron. It seems innocuous, just one document. And sure, it's routine. It's an annual occurrence. Except for this time, it's going to end up being the catalyst that triggers the whole damn collapse.
What kind of time frame are we looking at here, Porter?
Well, you know the famous Hemingway phrase about how people go broke. 2 ways, gradually and then suddenly. That's no joke. That's the boom and bust cycle. Stairs on the way up, elevator shaft on the way down. So look, it's not panic time yet, and there is still time to prepare. There are some simple steps that you should have already taken, but you still can. You can still protect yourself today. The cracks are getting very obvious to see, so there's not much time left. So I'm going to lay out the entire case for everyone today, and I'm going to reveal what this government document is and why it's about to bring our entire country to its knees. Because I guarantee nobody is considering the impact that this is going to have on all of our lives.
And what impact will this have for the economy, for people's portfolios? What does it mean for regular Joes with their retirement money riding on the markets?
Aaron, traditional portfolios, they're going to get absolutely creamed. I guarantee it. Think about this. Most investors are still holding 60-40 portfolios. Those portfolios were designed for a world that no longer exists. They're designed for a hard money world. We have paper money now. And people don't understand this. They don't get that the paper money ruins all of the protective value of the bonds. And that's why they still own so many bonds. But look out. When these forces converge at once and this storm finally hits, you're going to see the 60-40 portfolio get cut by more than half overnight. So unlike the COVID crash, you're not going to see it bounce back either. The first 50% shellacking, that'll just be the first down leg. By the time this is all over, financial assets will have fallen by 90%.
I mean, are you talking about like another lost decade?
No. More than another lost decade. We're talking about another lost decades. This is going to be the biggest financial storm that America has ever seen in its entire history.
Okay, Porter, this is exactly what I want to explore in this podcast with you. What do people do next when this happens? Where do they go?
Well, I've built something that can put an end to this nightmare for people. We call it the solution. It's right here. And it's exactly what I'm going to reveal to the listeners today, the exact solution that can save you from this entire crisis.
Well, that brings us to another massive reveal we've got for our listeners in this podcast, because you've actually built something to survive this and profit from it. And you're going to walk our audience through an easy way to avoid a lot of the sleepless nights that could be coming soon for our listeners.
That is right, Aaron. I'm going to pull back the curtain. I'm going to show everyone listening to our show what my subscribers have been paying for years. And later on the show, I'm going to personally show you how to triple that result. But you don't need to worry about any of that for now. Let's just talk about the solution.
And a heads up for everyone here. Porter launched the portfolio last year in September, and the results are absolutely smashing it. How much did it climb in its first full year?
Well, full year returns are 25%. And look, that's okay at first glance. 25% might not be smashing it by some people's definitions, like, the crypto people who are used to being up 1,800% in a week. But what I want everyone to understand is the stock market overall was only up about 18% in the same time frame. So this portfolio, the solution that I'm talking about, actually outperformed the entire stock market by a substantial amount. And it had a Sharpe ratio, which I'm going to explain, of 1.75.
I mean, that's basically a measure of risk-adjusted returns.
That's right.
The higher the ratio above 1.0, the better, meaning your portfolio is delivering more excess returns per unit of volatility.
That's exactly right. And even the best hedge funds in the world typically have Sharpe ratios under 1. My portfolio, the solution, is nearly double that. And here's the best part. The portfolio's beta, the solution's volatility, is about half that of the market's. So you're going to have returns that are better than the market, and you've got volatility that's less than the market. Look at the chart. My portfolio is the yellow line, and the S&P 500 is the white line.
God, Porter, that's nuts. That means his portfolio may be half as risky as the market overall, but delivers almost twice the results. And you call this portfolio the solution? Why?
Well, that's it, because this is the solution that everybody needs. This is my direct response to all the problems that have been caused by all of this inflation that we're seeing and by this historic convergence that's about to occur. Look, I've been through multiple market crashes. I've seen how crashes destroy people's lives financially. And listen, in various crashes, I've often lost a lot of money too. In fact, one of the crashes I lived through virtually cost me everything. So when I rebuilt my portfolio over the last decade, I asked myself this one important question. What would work for someone who can't afford to lose a decade of their financial life? What is a strategy for someone who can't afford to speculate on the latest tech stock? And what is someone who can't afford to risk their money on the latest mania? What's the solution for someone who can't suffer a 30 or 40% drawdown when the bubble pops? The answer was clear to me. It's this solution. It's a portfolio that is designed around a very simple financial principle that most investors have never even heard of. But it is by far the most exceptional piece of portfolio construction I've ever done in my career. Honestly, I've never seen anybody build a portfolio that's better than this. And the whole secret to it is the different components of the portfolio are inversely correlated to each other. So when one part goes down, the other part goes up. But when inflation runs wild, the whole portfolio goes up. So this is a portfolio that is designed to protect you from volatility and protect you from inflation. Plus, when the big deflationary moment hits, we've also got a big part of the portfolio that's designed to soar. So no matter what happens, no matter what's going on economically, a big part of this solution will be winning for investors.
Well, Porter, the world's largest hedge fund, Ray Dalio's all-weather portfolio, was built using a similar idea, right?
Exactly. And their annualized returns over the last decade have only been around 6%, which is not great. But their goal was not maximum returns. It was slow, steady growth with very low volatility.
But you've built upon that, built something that does deliver maximum upside, while also maintaining the low volatility people crave. And you're going to show people exactly how this works? The positions, the allocation strategy, everything?
Everything. I'm going to put everything in my solution on screen for you to evaluate.
And you say this is easy too, right? Set it and forget it? Because I think people hear internally hedged portfolio and they think it's going to be some complicated strategy that needs constant monitoring.
No, it's exactly the opposite. I mean, one of the things I know for sure is if you want to have a foolproof system, it's got to be set it and forget it. Otherwise, you're going to screw it up. This is the simplest portfolio I've ever seen built in my entire 30-year career. There are just 4 buckets in the portfolio. That's it. We're investing in 4 things. The positions are liquid and they're simple. And here's the best part, Aaron. How often do you have to check the portfolio? Once a year. That's it. Literally, you set it and forget it, and you come back a year later and you rebalance, and that's it. This portfolio has been built for the modern economy, but there's a version of it that's publicly available and has been around for over 50 years. And guess what? It's been outperforming the S&P 500 too. And I'll even give you the ticker symbol of that portfolio in a moment.
Right. Here's what I want our listeners to take away from this. You're reliably trouncing the returns of the market with significantly lower risk.
Exactly.
And you're going to show our listeners how they can take advantage of the wealth transfer that's getting underway.
Exactly.
And potentially get similar returns like these themselves.
I think it's a lock that they will.
But before we dive deep into actual positions and show people your screen, I just want to explain to anyone who's here that this isn't the first time you've helped investors navigate some pretty insane times.
No, this is not my first rodeo, but I do want to say we haven't ever seen anything like what's about to happen before. None of us have in our entire lives. But yeah, I have seen some big blowups in my time.
I mean, Porter, you started your own financial research company way back in 1999 from your kitchen table, armed with just $36,000 in startup capital and a laptop.
Well, it was a borrowed laptop, actually. Yeah. And I know you know this neighborhood. My home office was in one of Baltimore's most notorious ghettos. I mean, it was pretty much right where they filmed The Wire, if you remember that show.
I remember you telling me the story about the prostitutes that used to sit on your front porch. Remember when you were jogging, what would they say?
Keep on running, Whitey.
But you grew that kitchen table operation into one of the industry's most respected research firms, which went public in a multi-billion-dollar IPO. But here's the thing that really matters. Over the last 3 decades, you've earned an army of loyal followers. These are investors who've hung on your every word through various market cycles, crashes, and recoveries. And there's a reason for that loyalty, Porter, because you've got a track record of seeing what others couldn't. The 1997 emerging market collapse, the Japanese 1998 banking crisis, the dot-com blow-up of the 2000s, the demise of GE, the bankruptcy of General Motors, and a 2008 financial crisis, along with the fall of Fannie Mae and Freddie Mac. You warned of these catastrophes and many others long before Wall Street or mainstream financial media. But now you're warning of a bigger crisis. It's the everything bubble. Let's talk about that. Because a question on everybody's mind is, when is it going to pop?
Yeah, Aaron, I don't think that's actually the right question to ask. It's very obvious that we're in dangerous territory. Pretty much everyone knows if they've been around the markets. I mean, if you look at what Paul Tudor Jones is saying, if you read what Jeremy Grantham has been writing, or you've been listening to Ray Dalio, everybody knows that this everything bubble is going to pop eventually. But obsessing about when the bubble will burst is the wrong approach, because the simple fact of the matter is nobody knows for certain. You cannot know the day it will end. You just can't. Instead, you and all of our listeners, we need a solution so that it doesn't matter when it happens at all, because your portfolio is already secured. You've already got your safeguards in place. And that is how I sleep soundly every night. The bubble doesn't bother me anymore because I know when the end comes, I'm already ready for it. If I was invested in this market right now without my solution in place, I don't think I could even come to work. I'd be a wreck. I couldn't handle having my net worth, my retirement, all the money I've saved for my kids' college. I don't want to put that at risk in this kind of market. Heck no. When everything's trading at 50, 60 times earnings and I know it's going to blow up eventually, I can't do that. So, and then think about this. If I didn't have the solution, where would I put the money? Would I put it into cash? I can't do that. Not when the government is running trillion-dollar deficits and the Fed keeps printing money to buy more treasury bonds. I mean, I know where all that liquidity is going to go. It's going to go into more inflation. So I'm going to lose my savings if I'm out of the stock market, and I'm at risk to lose my savings if I'm in the stock market. Look, everyone else has done this math too. And that's why the S&P 500 stocks have become so representative of our entire society. Everybody has been hiding their wealth in the stock market, but it's not safe. So eventually everyone is going to pull out. And when that happens, there's going to be a huge crisis. Meanwhile, the entire thing, what's propelling the economy and the stock market, is boiled down to 7 companies. You know the stocks: Meta, Tesla, Nvidia, Amazon, Alphabet, Microsoft, and Apple. This stat is unbelievable. Those 7 stocks account for about 40% of the entire S&P 500's value. And the S&P has now become larger than our entire annual GDP. So stocks have never been this large relative to our economy, and they've never been this focused in such a small number of companies.
Yeah, but why is that such a problem?
Well, because when you buy an index fund, you think you're getting diversification. You think you're investing in 500 companies, but you're not. What you're doing right now is making a hugely concentrated bet on 7 companies, all of whose revenues and earnings and everything is so inflated by the AI bubble right now. These companies are trading at almost 30 times earnings. Meanwhile, treasury yields are sitting at 5%. That is a giant mismatch in valuation. Look, They're great businesses. I mean, I think Apple is a great company. I love their products. My solution is stored right here on a Mac. That's an Apple computer. I'm a fan. But do you know that Apple hasn't grown its revenues or its earnings meaningfully in about 5 years? Meanwhile, it's trading at 35 years worth of earnings. And that's one of the more reasonably priced of the Magnificent Seven. Tesla is trading at something like 200 times earnings. These are numbers that are absolutely going to guarantee tremendous chaos when the reality arrives. At current interest rates, a healthy PE ratio for these stocks should be something between 12 times and 20 times, depending upon revenue growth. But here's the really scary part. The Magnificent Seven are pouring staggering amounts of their capital into AI infrastructure right now. Aaron, they're spending close to $500 billion a year on AI infrastructure. And that spend is what has been propping up the entire stock market. Not just their stock prices, but the entire economy. Semiconductors, data centers, cloud infrastructure, the whole ecosystem. Microsoft alone is spending $50 billion every year on AI capital investments. This huge spend has created an illusion of a booming economy. But when you strip out that Magnificent Seven and you look at the rest of our entire economy, it tells a very different story. Look at this. The median stock in the S&P 500 is actually underperforming significantly. Small caps, they are getting crushed. They're way off their highs. This disconnect tells you everything you need to know about the real underlying economy. Meanwhile, these 7 companies are spending $400 billion building AI empires. Well, how long is that going to last when the American consumer is drowning?
Yeah, I mean, I don't disagree with you, but...
Well, look, consumer credit card debt is now at a record $1.21 trillion. Over $1 trillion in credit card debt, Aaron. People paying what, 20, 25%, 28% interest rates on $1 trillion in credit card debt?
Yeah, so you've got this bizarre split-screen economy. Tech giants spending like there's no tomorrow, while Main Street can barely make minimum payments.
That's it. And everyone knows what is coming. You've got Lisa Shallett. She's Morgan Stanley's CIO. She's saying the AI gold rush could lead to a Cisco moment at any time. The CEO of Goldman is worried about the AI frenzy causing a sharp drawdown. And Jamie Dimon from JP Morgan has said the market is bubbling up and, quote, that is cause for concern. So look, Aaron, imagine if just 1 or 2 of the Mag 7 stocks stumble. Well, all of a sudden, the entire AI thesis will collapse. And we're not talking about a typical correction when that happens. We're talking about the kind of drawdown that will erase a decade of gains or more. This is the kind of bear market that forces people to postpone retirement for a decade or forces them to come out of retirement so they can pay their bills. This is why the 4-part allocation strategy that I've built in my solution is so powerful. Look, when tech crashes, about a quarter of my portfolio will surge higher. And I'm going to give our listeners the exact stocks and asset allocations to protect themselves from this in just a moment. But first, it's really important for everyone to understand the full scope of what we are facing in this market.
Yeah, absolutely. Can we talk about the effect of inflation? Help me understand, Porter. If consumers are tapped out and struggling, doesn't that usually mean deflation, not inflation?
Man, that is a great question, Aaron. And that's exactly the trap that most economists fall into. They look at weak consumer spending and they think, oh, demand is falling, so prices are going to fall too. But the government is running nearly $2 trillion deficits at full employment in our economy, Aaron. This is not a recession deficit. This is structural spending, and they can't finance these deficits with honest money. The only way out is printing, and that guarantees sticky inflation. So look, the government's telling you that inflation is 3%, maybe 4% in a bad year. You can't believe it. If you actually calculate inflation the way they used to back in the 1980s, or by using the Chapman Index, which I've showed you, which measures actual real prices, then you actually will see that the cost of things that people are buying every day, groceries, housing, healthcare, insurance, education, the real inflation rate has been running at about 12% a year for years. Let me show you the difference.
Every American knows their inflationary numbers are lies, and this proves it, Porter. Why does the government always lie like this?
Well, they have no choice. This is really important, Aaron, and I want everybody at home to please pay attention to this. If you have a pen or a pencil handy, take down some notes here, because here is the most important part. In 1975, Congress passed a law that requires the Social Security Administration to automatically increase retirement payments each year to match the government's official Consumer Price Index numbers. That's the exact moment the government decided it had to start lying. So for context, back in 75, the average Social Security recipient got benefits every year equal to about 1.2 ounces of gold per month. Today, the same recipient only gets about 0.5 ounces of gold in payments per month. So that's less than half of the purchasing power that Social Security recipients were getting in the 1970s.
I mean, Porter, it seems like we're all screwed.
And this is precisely why I built a portfolio where 25% is allocated to hard assets that cannot be debased by government lies. And I'm going to show you exactly which assets I'm talking about in just a few minutes. But first, you got to understand why the traditional 60-40 approach to investing is dead. Because all of these changes, all of the government overspending, the deficits, the debt, the inflation, it's all getting worse. It's accelerating. And that means the government can't actually save anyone from it anymore. In fact, the government can't even save itself. Social Security is sitting on over $100 trillion in obligations that it has promised, but it can't possibly pay. So by 2030, and that's only, 5 years from now? Maybe not even 5 years, 4 years from now, really. We're looking at roughly 150 million Americans trying to support 120 million dependents. So that's nearly one retiree for every single worker, Aaron. That is a Ponzi scheme and its final collapsing act. And how are they going to possibly do that with inflation running above 6%? The money runs out in 4 years, not in a decade, not someday. 4 years from now, Aaron, there will be a crisis and Social Security will collapse.
Hold on, Porter. You're saying when that happens, literally benefits vanish overnight?
That's right. The retirees are going to get nothing, and the government's credibility will implode. The only way the government can avoid admitting that the program is completely bankrupt is to keep lying about inflation. They have to pretend that the benefits are going to keep pace with the cost of living. Meanwhile, as you know, they're not, and the recipients are getting crushed. And that's where it gets really dangerous, because these same kinds of lies are propping up not just Social Security, but the entire financial system.
How so?
Well, because the government has $38 trillion in debt. So if interest rates were actually being set by the free market, and if we were using real inflation numbers, then the rate that the government would have to spend on that debt, the interest rate, it'd probably be around 15%. Well, obviously, at that rate, the government would go bankrupt overnight. There is no way they can afford any kind of an honest interest rate. They cannot afford honest inflation numbers. They can't let honest numbers exist, so they have to suppress them. They have to keep pretending that inflation is less than 3%, so they can continue to borrow at 4% instead of 15%.
But that creates a trap, doesn't it? For everyone holding dollars or government bonds, I mean, what are they going to do?
That's right. So anyone who is in cash or is investing in traditional bonds is getting robbed blind. You know, you're getting about 10% of your wealth stolen every year from you. And if you think you're playing it safe in a money market earning 4%, you're actually losing between 8 and 10% a year. So every year, you're going to fall further and further behind. In just the last 5 years, Aaron, Americans have lost a quarter of their purchasing power. So this is not just about a market crash. It's not just about a market correction. This is an ongoing systematic wealth transfer from savers who have done the right thing to debtors who have done the wrong thing. When with all of these events converging at once, that confiscation rate is about to go into absolute overdrive. And we haven't even talked about tariffs yet.
Right. Trump's been talking about implementing broad tariffs. How does that play in all this, Porter?
Well, think about it. Tariffs are just taxes. They're taxes on imports. That means they're inflation accelerants, pure and simple. Some of the costs might get absorbed by foreign exporters, but eventually all the cost has to be passed to consumers. Obviously, right? People don't do business for charity. They do business to make a profit. So if their costs go up, your prices are going to go up. And we saw this in Trump's first term. He imposed tariffs on washing machines. What happened? Washing machine prices jumped 12% overnight. And then the prices on dryers also went up 12%. Why? Well, because manufacturers realized they had pricing power. So they're going to go ahead and get as much as they can. It's what economists call pass-through inflation. Now multiply those kinds of impacts across every sector in the economy: clothing, electronics, furniture, car parts, building materials, wine. We're already running 12% real inflation. If you put 25% tariffs on top of that, you could easily see real dollar CPI of 25 to 30% a year.
But isn't this just heading towards a stock market crash? I mean, we've had those before.
No, this is much worse than just that. And we know exactly what's about to happen. What's the government going to do? Instead of trying to stop inflation, even in the face of tariffs, the Fed is going to slash interest rates. Trump is already demanding that they do it. And then they're going to print more money. In fact, it's already happening. We know this because the Fed has recently purchased over $43 billion in treasuries. And in the meantime, the Treasury is doing another $20 billion Treasury buyback. Why? Well, because they're the buyer of last resort and no one else wants the government's paper. And you know what this is, don't you? It's just quantitative easing all over again. They're printing money and they're doing it in ways that they think no one will see. But we already know what's happening and we know where this leads.
It's going to kill a dollar, Porter.
It's absolutely happening right now in real time. The evidence is overwhelming. Look at gold. Gold's at record highs. Why? Because they're printing money again.
Yep, it's around $4,000. I mean, that's up 58% year to date.
People are talking about this less, but silver just smashed through $50. That's an all-time high for silver, and that's a 65% gain year over year. And Bitcoin? Well, Bitcoin trading broke records in 2025 too, of course.
Yeah, Porter, people are fleeing to hard money in droves.
And if you want more proof that the U.S. dollar is collapsing, well, let's talk about foreign governments, because they've turned on their heels and they are walking away from our treasury. China, Russia, Saudi Arabia, they're all buying gold like they never have before, and they are dumping dollars. Foreign ownership of U.S. treasuries has fallen to just 30%. They're getting away from the dollar forever. And at some point very soon, they're going to call our bluff on the entire bond market. It's happening right now, exactly as I predicted it would more than a decade ago.
And then when they call our bluff, what does that look like?
Well, the entire financial system collapses. Social Security checks, they bounce. Inflation explodes because the Fed really has to print just to keep the lights on. And by the way, that's the end of the social fabric of the United States. Violence, rioting, grocery store looting, it's all going to come apart.
I mean, you're talking Civil War. You really think it could get that bad?
Aaron, if you asked Americans in 1859 whether a civil war was coming, they would have laughed. They couldn't imagine 700,000 people dying, including 100,000 civilians. But that's exactly what happened. And I am telling you right now, we're heading into something worse. When Social Security fails, when the banks close, when inflation destroys people's savings, when the government can't meet any of its obligations, you're going to see violence erupt on our streets like you've never seen before. Honestly, at some point in the future here, historians are going to date the beginning of America's second Civil War to the fall of 2025. And the casualties will not be in the hundreds of thousands, Aaron. The casualties will be in the tens of millions.
I mean, this is the stuff of nightmares.
That's exactly my point. There is going to be a trigger, a catalyst. There is going to be something that forces the market to begin to acknowledge reality. And I can't know for certain what that's going to be. But I suspect it could be the next trustees report on Social Security. Because when those numbers come out and show the fund depleting decades faster than projected, I think that's going to be the tipping point.
When's that next trustees report due?
Well, listen, officially, they're supposed to publish on April the 1st, 2026. But in reality, they almost always miss that deadline. So I don't know exactly, but it'll be next spring.
Well, it's terrifying to think what will happen in that moment. What do you think will happen when the public realizes that Social Security is a scam? Retirees will panic, that's for sure. They'll start pulling money out of everything.
Yeah, there's going to be massive forced selling, that's for sure. And when foreign creditors see what's happened, the insolvency in black and white, they're going to start dumping treasuries even faster than they have been. At some point, the Fed is going to be forced to choose in real time. Are we going to let interest rates go above 10% and crash the market, or are we going to print money and absolutely destroy the dollar?
Well, politicians start pointing fingers. The media goes into overdrive.
Yeah, and the printing presses get heated up and go on full steam. So look, when the selling starts, there's no diversification that's going to cushion the blow if you are invested in a 60-40 portfolio. The indexes are going to collapse because the index is the Mag 7 stocks, and bonds are going to get destroyed because the government's printing money and everyone's dumping treasuries. And that's when all hell is going to break loose. People are going to get locked out of their retirement accounts because the funds are going to freeze redemptions. Safe institutions, they're going to seize up, they're going to close their doors, liquidity is going to disappear.
Who would get hurt the most by this?
If you're in your 20s or your 30s and you own some gold, you'll probably be fine because time is on your side. You can, of course, rebuild your accounts. You've got a lot of time. But if you're relying on your portfolio for retirement, or if you're already retired already, you're looking at something that's worse than a lost decade. You're looking at a 20 or 30-year period to try to recoup what you're going to lose in this crisis. And it's obvious that many people cannot afford to lose 20 or 30 years. For those people, it's going to be a life-changing disaster.
Fair warning. If you're out to scare our listeners, I think you're doing a great job, Porter.
Yeah, I do want to get people's attention, but that's not my goal, to scare people. I don't want you to be frozen in action. I want our listeners to be fully informed, and I want you guys to be equipped for what's ahead. Look, here's the good news. There is good news, and I want everyone to hear this loud and clear. Like I've been saying, there is a way to protect yourself from all of this. It's the solution. It offers you a foolproof way to safeguard yourself against all of these problems.
So it's an insurance policy against a total collapse?
It's actually better than that, Aaron. It's an insurance policy that pays out all the time, not just when a disaster hits. Normally, with insurance, you've got to suffer a real collapse, some turmoil, some tragedy before you get compensated. But with my solution, if this ends up being 3 years away or 4 years away, it won't hurt you. It's going to be accumulating wealth the whole time for you through virtually any market condition. Bull market, it'll do good. Bear market, it'll do great. And everything in between. This solution does so much more with less risk than any other portfolio approach I've ever seen in my 30-year career. And this is what I'm going to give to our listeners. The precise allocations that you can make right now that can make your portfolio virtually untouchable in any economic environment.
Listen, guys, we'll get to it soon. But Porter, can you talk about where the idea for this portfolio came from then? Before you walk us through it and show us the results, because there's a very specific system here that makes it work so well. And I think our listeners need to understand the theory behind it.
Okay, but heads up, this isn't going to make you the most amount of money. If you want to go and speculate on Palantir or the next AI stock, if you're looking for a moonshot recommendation that can pop 500% in the next 12 months, well, this strategy is not that. I built this solution for people who want maximum upside with minimum risk. It's for people who don't want to spend their lives chasing the next hot stock or analyzing balance sheets every weekend. Because look, I'm obsessed with this stuff, but I understand most people aren't. Most people just need a solution that really works. They want to make money, they want to protect what they've built, and they want to go enjoy their lives. They don't want to become an amateur hedge fund manager in their retirement. And that's exactly what my solution gives you. This is a complete solution that you can set up once a year, you rebalance it a year later, and you forget about it otherwise. You don't have to buy anything, you don't have to sell anything, or at least not more than once a year. And you don't have to follow the news. You don't have to worry about the future, because this solution is a portfolio that is structured in a way that makes it extremely difficult, almost impossible, to lose money. So no matter what happens to the economy, no matter what happens to an individual stock, no matter what happens to the Mag 7, you're going to be okay.
You've told me before that the idea for this crisis-proof portfolio, the solution, started because of Harry Browne. Can you explain his investing philosophy to our listeners?
Yeah, I'd love to. As you know, Harry was one of my greatest intellectual mentors. For the audience, if you've never heard of Harry Browne, he was an economist. He was a libertarian philosopher. He was just a brilliant, independent, and contrarian thinker. But he wasn't an ivory tower academic. Aaron, this is a guy who ran for the presidency twice on the libertarian ticket. And he wrote some of my very favorite books. My best that I like is How I Found Freedom in an Unfree World. But he also wrote something that you guys might really like, Fail-Safe Investing. The ideas in those books, they changed my entire life.
And Porter, you actually met him too, didn't you?
Oh yeah, several times. Yeah, we were friendly with one another. The first time I met him was in 1996 at the New Orleans Investment Conference Speakers Dinner, where he explained these concepts to me for the first time in person. You see, Harry lived through the 1970s when inflation hit 18%, when gold shot up more than 2,400%, and when the stock market went nowhere for a decade. Harry watched regular Americans get financially slaughtered because they bet everything on one outcome, the stock market. So Harry had this incredible insight. He said, look, I don't know what's coming next. Nobody does. So instead of pretending that I can predict the future, I'm going to build a portfolio that will win no matter what happens. And instead of trying to predict the markets and time the markets, Harry built a portfolio for protection, one that was internally hedged. And in doing so, he taught me 30 years ago the greatest secret in all of finance. Aaron, we can show the listeners how to earn equity-like returns without taking equity market risk.
And his big idea was a permanent portfolio, the inspiration and namesake for your version, Porter.
That's exactly right. Harry's permanent portfolio was genius, and it was so simple. All he did was have 4 equally weighted positions, and each one is designed to profit from a different economic scenario. So Harry put 25% in stocks. If the economy grows and companies do well, your portfolio is going to go up. And he also put 25% into long-term government bonds. That's for when a deflation happens or when a recession hits and interest rates go down, which makes bond prices go up. Another 25% went into gold. Why? Well, that's to hedge the risk of inflation and to protect against the inevitable collapse of our paper dollar. And then a really interesting part was 25% he kept in cash. And that isn't going to make you any money when it's sitting there, but when a panic hits, you will have cash ready to buy the greatest businesses in the world when they're selling at fire sale prices. And that, over time, is a great way of diversifying your assets. And look, this approach, 25% in stocks, 25% in bonds, 25% in gold, 25% in cash. It's not sexy. It's not exciting. There's not a lot to do, but it's absolutely bulletproof.
Okay, when you say bulletproof, how did this exactly play out in practice? The whole premise was to grow your wealth with very low volatility. Is that correct?
That's right. So some people got together and created a mutual fund based around Harry Browne's ideas. The Permanent Portfolio Mutual Fund. The ticker symbol is PRPFX for anyone who's interested. It was launched in 1982 and again is based on Harry's structure, the portfolio allocation strategy that he first revealed. So if you look back, it's been around for 42 years now, and it's compounded at over 7% a year. Now, you might compare that to the S&P 500's long-term average of 8%, and you might think that's not too impressive. But with Harry's fund, you got almost none of the volatility that comes with the stock market. So in 2008, for example, when the S&P 500 fell more than 50%, Harry's strategy was only down 27%. In other words, Harry's portfolio has captured, say, 90% of the upside of the stock market, but has only delivered about half of the volatility. So that allows investors to avoid a heck of a lot of risk, sleep soundly at night, and also, very importantly, allows them to avoid trading. So they don't have to trigger taxes. They don't have to take extra risk. There's really nothing to do. They just set it and forget it, and they know that they are protected.
Okay, that's nice.
Yeah, Harry's approach was great, and it was very sophisticated for its time, and of course, it still works to this day. So if that's all you want to do, you can easily just do that. You can buy 4 ETFs, you can rebalance every year, you can go back to sleep.
But Porter, you found a way to dramatically improve it.
Yeah, dramatically. So I've updated this idea with modern holdings that are better positioned for today's markets and, most importantly, for what's coming next.
Okay, so what do you suggest the modern permanent portfolio should look like for our listeners?
All right, let's go through this in detail, sleeve by sleeve.
Okay, now we're getting to the really good stuff. Let's start with bonds, Porter. Did you keep the bond allocation the same as Harry's?
Hell no. Absolutely not. In Harry's day, you use long-term treasuries as your safety net. But look, the modern world, that entire strategy is completely broken. Bonds are uninvestable. Look what happened after COVID. When inflation hit and interest rates rose, long bonds got destroyed. The iShares 20-year plus duration Treasury ETF, the symbol everybody knows, TLT, it has lost about 50% of its value between 2020 and now. So no, I do not trust bonds. Absolutely not. But there's a much better way to buy bonds. It's a way that allows you to manage that duration risk. And how do you do it? You buy bonds through investments in property and casualty insurance companies. Here's why. Insurance companies collect premiums up front. They get a whole bunch of cash. It's called float. And they hold that money for years before they eventually have to pay out claims. But in the meantime, they get to invest all that float. And what do they buy? They buy bonds.
Ah, okay, I get it. So instead of you buying bonds directly and getting killed by inflation, you let these world-class bond managers invest on your behalf. Am I following this right?
That's exactly right. If they underwrite profitably, so if they handle the risk of their insurance policies, and these good firms do, the policyholders are basically handing them capital for free. So when interest rates rise and crush bondholders, these insurance companies actually make more money because they're earning higher yields on the new investments. Let me give you a really good concrete example of what I'm talking about. And for those listening, this is actually one of my favorite investments I've ever made in my entire life. It's in my personal portfolio, and it's, of course, in our solution. And I'm going to give you the exact stock ticker right now. This is a company that most people have never heard of, but it has been generating wealth for its shareholders for over 50 years. This is an insurance company called W.R. Berkley, and the ticker is WRB. Since the early 1970s, its compounded book value at over 16% a year. That's through the stagflation in the 1970s, through the big crash of '87, through the dot-com bubble, through the '08 crisis, through everything. And get this. Remember how bonds got massacred in 2022 after the COVID collapse? Well, W.R. Berkley's investment income went up that year by 47% because companies like W.R. Berkley actually make a profit twice. They make a profit from their underwriting, so their insurance sales, the premiums that they get from selling insurance, and then they can make another profit by investing all of the float. And they're able to do that by making smart investments in the bond market. And that means they're literally better than bonds because, ironically, rising interest rates actually helps insurance companies instead of hurting them. I just buy the companies that own gigantic bond portfolios. Those companies manage the bonds actively. They manage the duration risk. And they do a way better job of that, Aaron, than me or you could. And here's the best part. I don't have to pay them to do it. In fact, they pay me because I get a dividend. So these are multi-billion-dollar bond funds, and they have a profitable insurance wrapper on top. And their performance has crushed treasuries over the last decade and probably for longer than that. But look, if you had just invested in W.R. Berkley back in 2015, you'd be up over 400%. No way you're making anything like that in bonds directly. Property and casualty companies are some of the best investments in the entire world. They are so good, in fact, I nicknamed them God's investment. I mean, I could go on and keep selling you property and casualty insurance stocks all day long.
Oh, Porter, I know you could. But listen, for everyone tuning in, folks, Porter put together a full guide explaining all the details on why property and casualty insurers can make such great investments, how to identify the best companies in the space, and go into detail on the special characteristic of property and casualty industry that Warren Buffett loves so much. The report is called God's Investment, and you can get a free copy of it today. All right, this is great stuff. You took Browne's 4-part portfolio and improved the bond part by using property and casualty insurance companies. That gives roughly the same impact of owning bonds, but you're getting the world's best bond managers doing the work for you. So what about the stock sleeve? Does that stay the same, or have you upgraded that?
Yeah, so we've upgraded the entire approach, and the stock sleeve is a little bit different. You see, Harry used to urge investors to just own the market. But Harry was an economist. He wasn't really an investor. And that advice made sense in the 1970s because that was a time when the markets were deeply undervalued. There was already high rates of inflation. There had already been economic shocks. And so the safest way for ordinary investors to grow wealth was through broad passive market exposure rather than making individual risky bets or attempting to time the market. But today, the market's very different. Today, the market means you're massively overexposed to the Magnificent Seven stocks. And we don't want to own those. They're just too expensive. Instead, we want to own what I call Lindy companies. And this is a really cool idea. If you go back to the 1960s, New York comedians used to hang out at a deli in Manhattan that was called Lindy's. And they'd go there after their late night gigs.
Ah, yeah, I've heard of it. It was the stuff of legend. Jimmy, can you find that for us? There we go.
Ah, that's it. Yeah. Yeah, that's it. Lindy's. Anyways, the comedians, they had this theory. They called it the Lindy Law. And their theory was that the more TV airtime that they spent, so like if they have a regular weekly series, if they're on TV all the time, that pretty soon they're going to run out of jokes. And then their careers would sputter out. But reality is the opposite. The reality is the more time they spent on TV, the better their jokes got and the better their careers got. And guess what? That happens with all kinds of things. The longer, for example, a book has been in print, the more likely it is to be in print in another 50 years. Way more likely than a book that's never been in print before coming to market. And this goes on in all kinds of things. And there was this great author, Nicholas Taleb, who studied this phenomenon. And then I began to apply it to stocks in the stock market. Because my theory was, if a company has been around for 50 years, it's probably doing something right. And it's going to have a much longer lifespan than ordinary. So this is what I call the Lindy secret of investing. It's a really simple idea. The longer a company's been around, the more likely it is to survive, even something like a giant crash. And so if you look in my portfolio, you're going to find that instead of owning the S&P broadly, instead I have purchased 20 different stocks that benefit from this Lindy effect. These are companies that no one can kill. They compound their earnings year after year, they pass costs on to consumers, and they reward shareholders. And they've proven that they can do it across decades and decades and decades. I mean, these companies are still going to be here when your grandchildren are grown. They are great, legendary businesses. Aaron, we're talking about Coca-Cola. Okay, it's raised its dividend annually for 63 consecutive years, and it never cut its dividend even in the Great Depression. Or Microsoft. Sure, Microsoft is a newer company than Coca-Cola, but it's been around for more than 40 years, and it's the backbone of modern computing. Meanwhile, it's got zero net debt, and it's been raising its dividend decade after decade after decade. And of course, it's a software company, so it's extremely capital efficient. Or my favorite, Philip Morris International. People literally pay higher prices for cigarettes year after year after year. It's incredible. Remember, Aaron, the aim of the game as an investor is to survive, to ride out the volatility, to be anti-fragile, to avoid getting wiped out by these black swan events.
So you want companies that have been around forever, because if they've been around forever, they will continue to be around forever.
That's exactly the Lindy strategy. That's right.
And a quick note for our listeners. Like our God's Investment Report, Porter has a special report that further explains the Lindy effect and highlights the top 25 Lindy companies in the world today. It shows you how to identify these immortal businesses and walks you through constructing your own Lindy-style equity sleeve. If you act today, you can get this report for free. So, okay, you've replaced bonds with property and casualty insurers and the S&P 500 index with great Lindy companies. That brings us to gold next. The hard money hedge. What about that?
Yeah, let's talk about the gold, because this is actually the single most important part of the permanent portfolio. And I still use gold, but I also want to have some Bitcoin allocation. Okay, so if you're like, Bitcoin, I would never buy Bitcoin. Hear me out. Harry's gold hedge was designed for 1970s style inflation. But today's currency risks are digital, they're global, and they're moving at a much faster speed. Now, it's true that Bitcoin isn't a perfect inflation hedge day to day, but that's why we keep our Bitcoin allocation small. It's just over 10% of the portfolio. But even that little small slice can meaningfully boost the performance of the hard money allocation. You see, unlike a stock or a bond, Bitcoin is no one else's liability. It can't be printed, and supply of Bitcoin is forever capped at just 21 million coins. When adoption keeps spreading, and it is, sovereign funds are buying Bitcoin, pensions are buying Bitcoin, corporations have begun buying Bitcoin in their treasuries. Bitcoin has the potential to do what gold can't. Bitcoin can reprice a broken currency system instantly. And what if it doesn't? What if Bitcoin doesn't end up being the digital solution that I believe it's becoming? Well, that's okay, because gold is still doing all the heavy lifting in our portfolio. So together, gold and Bitcoin make the very best hedge against monetary chaos, and that's what we're heading for.
All right, very interesting. You've explained it very well. Porter, I know that you also recommend folks interested in this portfolio buy a specific gold stock, one of the only ones you recommend. All of your research on this is in a report that we've put together called the Ultimate Gold Stock. And this report can also be yours today for free. I'll explain how in just a minute. Okay, so that's 3 of the 4 buckets. We've got equities, We've got the bond proxy through insurance companies. We've got gold and Bitcoin.
That's right. So we got our bond allocation, we've got our stock allocation, and we've got our hard money allocation. And here's the part that a lot of people don't like. The fourth component is actually just cash. Now, Harry's original idea was to keep 25% of the portfolio in cash, but there's a pretty obvious flaw we've already covered in depth.
Yes, cash is being destroyed by inflation.
That's right. So I use short-term T-bills as an alternative. Specifically, I'm holding 1 to 3 year treasuries. Now, these are treasury bonds, but they're not long duration bonds. They're very short duration bonds, so they can help protect against the inflation or erosion. And you still have all the liquidity that you need when the market does crash and there's blood in the streets. So this is your way of having a war chest.
Excellent. Now, Porter, you've shown us the 4 sleeves. So let's talk about your actual results with this portfolio.
Let's do it. Okay, so for people watching the video right now, I've just pulled up this chart again. For listeners, I'm going to describe what we're looking at. There's a yellow line on this chart. That is the actual permanent portfolio that we launched a little over a year ago in September of 24. The white line, that's the S&P 500. That's the benchmark that everybody knows. It's the stock market. Now look at the spread. As I told you earlier, our portfolio was up 25% in its first year. And the S&P 500 over the exact same period was only up about 18%. Now listen, obviously, the past performance of a portfolio does not guarantee any future success. We're not saying so. The goal here, though, is to keep future success consistent and reliable. Aaron, you know, that kind of consistency is very difficult to achieve as an investor. We're not talking about a single stock that beat the market by 40%. We're talking about the entire portfolio combined beat the stock market. Now, given the turmoil and the volatility that I know is coming to the markets, the million-dollar question is, how well will the permanent portfolio protect us? How much is it going to make sure that we don't lose money? And the only way really we can estimate that is by looking at volatility. So we want to see, great, we made 25%, but how volatile was it? What were the monthly ups and downs like? And the answer is not volatile at all. Our beta, and that is a measure of volatility compared to the stock market, was less than half of the stock market's. So we are getting better than stock market results, and we're doing it with almost no volatility. Now, the fancy Greek word for this is called beta, and our beta was only 0.44, which means that we're less than half as volatile as the stock market.
Hold on, Porter. I'm lost a little bit here. Can you explain this beta thing?
Yeah, so beta is a Greek term, and I'm not sure why people in finance use Greek terms because we're not Greek. But anyways, it's just a way of comparing the volatility of a given stock or portfolio to the overall market. So if you have the same volatility as the overall market, then your beta would be 1.0. If your portfolio goes up more than the market and it goes down less than the market, well, then your beta could be higher than 1. For example, if the market moves 5% over a period and your portfolio moves 10%, your beta would be 2, meaning it has twice the volatility of the market.
Got it. And since this beta of your portfolio was 0.44, that means your portfolio had half the risk of the overall market.
That's exactly right. And remember what I said earlier about our Sharpe ratio being 1.75? That's almost unheard of. It means for the risks we're taking, which is roughly half the markets, we're producing more than double the reward.
All right, that's incredible. And it's great news if you're in your 50s or if you're in your 60s and you can't afford to get clattered by another massive drawdown.
That's exactly right. And that's why all this matters. If you're retired or you're close to retirement, you don't just need growth. You need predictable growth. You need smooth compounding. You need very low volatility, and you need ultimate downside protection so you can sleep at night. I'll give you some real examples from inside the portfolio so you can see why this works. Take the bond sleeve. Except, of course, like I explained, we don't actually own long-term bonds. We own property and casualty insurance companies. One of them is W.R. Berkley, which I mentioned earlier. It's a great business. Remember, these Property and casualty insurance companies are reinvesting at higher yields, making more money, and paying us dividends all along the way. And that's how you can turn what used to be a liability of a permanent portfolio, the bond market, into an asset that performs. Now, let's look at my stock sleeve. These are some of our Lindy companies. If you look back through history, around 4% of all the stocks create a vast majority of all the wealth in the market. And we've deliberately concentrated in just those kinds of stocks that are essentially immortal. Now, let's talk about the hedge sleeve. When I say hedge, we want to own things that go up when the stock market overall goes down. And the ultimate hedge is gold. And we don't just own gold, we own the very best gold company in the entire world. This firm has an incredible business model that allows them to make all the money from gold mining, but not have to pay for any of it. It is really, truly one of the most capital efficient businesses that's ever been created. And its performance is linked directly to the price of gold. And that makes it probably the very best stock in the entire portfolio.
All right. Now, Porter, didn't you pair this gold stock with a small Bitcoin allocation too?
Yeah, that's right. As I described earlier, we have a small allocation that is Bitcoin, and we do that through an ETF that you can buy in any type of investment account. You don't need to mess around with trying to own crypto wallets or having all these crazy passwords. You can just get exposure to Bitcoin just like you would buying a stock. Okay, and now, Aaron, there's the last sleeve, the cash sleeve. Now, again, this is the part that I think a lot of people get tripped up on. They're like, I don't want to own any cash. But you've got to own some cash so that you will have liquidity in the event of a market crash. But instead of letting your cash rot in a zero yield account, we're holding short-term treasuries, 1 to 3 year notes. And we do this, again, with an ETF. So it's very easy for you to buy, very easy for you to manage. There it is. That's it. That's the solution. And the results are right here on the screen. This strategy works.
All right, Porter, we need to wrap this up. But you mentioned your personal returns are actually higher than what the core strategy delivers. Dramatically higher, Porter. What's going on there?
Well, I don't know if I want to get into that. Yes, it's true that my personal returns are roughly about triple what the standard portfolio delivered in the first year.
All right. Well, I know our listeners are going to want to know what's the secret here.
Well, it's no secret. It's leverage. And I'm not suggesting that anybody should do what I'm doing with this information. And we're definitely getting into the advanced part of the course here. But the thing that I realized once I built this portfolio was that the volatility is so low. I mean, you're not taking really any risk when you own the solution. But what if you're like me and you're young enough and you have a high income, you can afford to take some risk? Well, how can you get this kind of portfolio to be riskier, to be higher performing? And the answer is, instead of having a cash portion of the portfolio, you start adding leverage. You start borrowing money to build positions above what your cash, what your investment account's actually worth. So you borrow money and you add to the positions. And if you do that, you can get much higher returns. Now listen, let me be clear. I'm talking about doing that in a safe way. I'm talking about using intelligent leverage. I'm not suggesting you go lever this portfolio 3 times or 4 times. Okay, but listen, it's got half the volatility of the stock market. So if you're leveraging it 1-to-1, you'll still have the same volatility of the stock market, but your returns will be closer to 50%. That's a really attractive offer for people who can afford that greater volatility. And also, I think it's very important to note that when you borrow money to buy stocks, you're also really participating in another hedge against inflation. Think about it. If inflation is actually running at about 12 or 13% annually, and you can borrow money at 4% to invest in stocks, well, that's a 9% annual arbitrage in my favor on every dollar I've borrowed. It's like buying a rental property that appreciates at 13% per year, but your carrying costs are only 4%. You're pocketing the 9% spread, plus you're building equity with the borrowed money. So more or less, I'm getting paid to buy these stocks.
That completely changes the math.
It sure does. But let me be clear once again. This leveraged approach is only for experienced investors who can afford the extra volatility and the extra risk. The key is that to do this successfully, you've got to have a low volatility portfolio with a very high Sharpe ratio. And that's what this portfolio does. So you can use it to be extremely safe, or you can use it to be extremely high performing. But listen, if you're going to do anything like that, you've got to consult with a professional financial advisor. You've got to understand what the risks and limitations of the strategy are. Because obviously, if you're borrowing money to buy stocks, and you don't do it the right way, you can lose a lot of money. You can lose your whole portfolio pretty quickly. And listen, even without the leverage, this core strategy is delivering market-beating returns. So you don't have to leverage it at all to beat the stock market. The leverage part is just for people like me who think that they can get to that next level and want to try. But listen, you got to be honest about what the risks are. You can't do this without really understanding what your maximum drawdown is going to be. And when I levered this portfolio, I knew that my maximum drawdown could be as high as 50%. So I'm doing it with my eyes open.
Well, that's incredible. All right, Porter. So we've covered a lot of ground here: the portfolio structure, the philosophy behind why this works, and the results. But I know our listeners are probably sitting here thinking, okay, how do I actually participate in this myself?
Great question. And first of all, I think I should mention my subscribers, the people who pay $2,000 a year for my core research advisory. It's called The Complete Investor. They've been getting access to this portfolio since I created it. They've been modeling my picks, following the rebalancing schedule, and implementing the strategy, and they're doing great.
And they're getting the same results, aren't they?
Absolutely. If they implemented what we recommended, they should be getting the core portfolio return, which is 25% since inception. And if they've been leveraging it, they should have made something between 60 to 80% over the last year.
Okay, I'm going to ask again. This is truly set it and forget it, because I think that's what a lot of our listeners want. They don't want to get glued to their screens every day watching every ticker.
Yeah, it's absolutely set and forget. Once a year, that's it. Once a year in late September, I'm going to send out the rebalancing guidance. My subscribers can make the adjustments, and I doubt it would take them more than about 10 minutes. And then you're done. You're done for another year. You can go back to sleep. You're not constantly trading. You're not trying to time the market. You're just letting the 4 parts of our allocation strategy do their jobs.
Yeah, and another thing, this isn't like buying some mutual fund where you're paying fees and getting piss poor results.
No, the opposite. I mean, one of the reasons why we own insurance companies is because we don't want to pay a bond manager. We don't want to pay management fees. We want to own the securities directly, and we want to get paid dividends. And as we discussed, with property and casualty insurers, that is an incredible strategy. You're getting paid a lot. And of course, with the Lindy companies, you're getting dividends on every single one of those stocks as well. So my subscribers are paying a lot less for their investments, and they're likely making a lot more.
All right, Porter, I want to share a few things a couple of your subscribers have said about this portfolio, because I think it speaks to why people trust your work. First one here is from Mark C. He says a permanent portfolio makes all the sense in the world. It's intellectually rigorous and refreshing. And here's one from David K. I believe Porter truly works for your benefit. He acts with fiduciary responsibility on behalf of his subscribers.
Man, I love these kind of comments. It's so nice when I see people who are able to actually implement the strategies. And what's so great about the permanent portfolio is it's so easy that there isn't really a way to screw it up. You just set it and then you forget it. In fact, one subscriber wrote in last month to tell me he was using this blueprint to manage his $20 million equity portfolio. These are real people with real money who are actually protecting their families with our strategy. It's incredible. It is a great solution, thus the name, The Solution. This is solving a real problem for everyday Americans, so they get to go back to work, they get to go spend time with their family, they get to do what they're good at, and they don't have to worry about all the craziness of the financial markets. I'm so proud of what we have done with this solution, Aaron.
Yeah, rightfully so. And that brings me to what I want to do here today for our listeners.
Uh-oh.
We're opening up a special invitation to our listeners today, people who now fully understand what's coming, and we're giving them a unique chance to construct a permanent portfolio of their own in a brand new package we're calling Porter's Permanent Portfolio Blueprint.
Wait a minute. Wait a minute. What exactly are we giving these people, Aaron? I mean, you're making me a little nervous. What's inside the offer? You've been mentioning all the stuff I spent years developing, truly, like my whole career, and you've said free a bunch of times. Look, I love helping people with finance. That's why we do this free podcast, but I don't work for free. I'm sure my subscribers don't work for free. I don't think anybody expects us to, just give them everything that we do for free.
Well, hang on, P. Let me walk you through what they're really getting, okay? Jimmy, can you display this on screen as we go along here for the people watching on this video? Okay, for the listeners tuning in, first and most important of all, you get the main full blueprint we've mentioned throughout the episode. This is Porter's complete masterclass on building a crisis-proof portfolio. Everything Porter just walked you through today, all of it documented in full detail inside this blueprint. It goes through sleeve by sleeve, explaining how and why each sleeve works and how you could construct it. There is even a section on how you can transition your existing portfolio in a Porter structure. Plus, this report contains the complete rationale behind the gold and Bitcoin allocation, as well as the tickers you'll need for the entire cash management playbook. It's all in here. Now look, we can't give away every company, every ETF, every decision. That wouldn't be fair to our subscribers who pay $2,000 a year to get this information. But we can give you the entire framework so you can build a crisis-proof portfolio of your own. And again, until now, the only way you can get access to this portfolio was buying a year's subscription to our flagship advisory, Porter Stansberry's Complete Investor, for $2,000. It's worth every penny too, because a complete investor has a ton of stock research, portfolios, special reports, covering just about everything in investing. But we wanted to make it easier and cheaper for the folks to get their hands on Porter's Permanent Portfolio Blueprint. So we broke out the blueprint and we're making it available for a one-time payment of just $199.
Shoo, okay. I was going to kill you if you said we're giving away our entire Porter's Permanent Portfolio Blueprint for free. I mean, I spent my whole career building this.
No, not the blueprint. But here's where this deal gets even better. If you order Porter's Permanent Portfolio Blueprint today, we'll include the other 3 reports we talked about earlier for free. So you'll get God's Investment, a report on the entire property and casualty insurance sector. And because this is where Porter made his biggest upgrades to Harry Browne's original formula, we think God's Investment is a must read.
Yeah, and I want to explain why we went so deep on the property and casualty stuff. You see, when I decided to replace bonds with insurance companies, I knew I had to get it exactly right. Insurance companies are really complex. The accounting is opaque, and most analysts really have no idea how these businesses even work. So my team and I studied the greatest insurance investors in history, Warren Buffett, of course, but also the families that built generational wealth through insurance, and there's a couple of them. The report Aaron is referring to represents the single most thorough analysis of the property and casualty insurance sector that you will find anywhere. And this research is exactly what's allowed us to do so well in property and casualty recommendations over many years. The portfolio that we built in property and casualty has delivered incredible returns year after year after year. I mean, I think since 2012, our property and casualty portfolio has beat the market virtually every single year.
I mean, we're not done yet because the insurance sleeve is only one part of the portfolio. We'll also include our research on the Lindy effect, which details the 25 immortal businesses that have dominated their markets for generations. Companies like Coca-Cola, Philip Morris, and Johnson & Johnson that have proven they can survive any crisis and compound wealth across decades. Again, this report includes the names and tickers of our top 25 Lindy stocks.
Aaron, could I show you a little bit of the Lindy index right now, if we can?
Absolutely.
Can we bring it on the screen? Okay, there you go.
Oh, that's cool.
Yeah, it's something I've been working on for a while. Honestly, if all you did was just buy these stocks, you'd be way ahead of virtually every other investor in the world.
Yeah, and remember, you can only see 5 on the screen, but there's a list of 25 companies in there. Everything you need to fill out that sleeve. Now, you've also got the hard money sleeve. We told you that half of this sleeve should be Bitcoin via an ETF, but the other half is in gold. To help you fill out this sleeve, we'll include our report on the ultimate gold stock. This briefing goes deep into the business model for the company, explaining how this company generates mailbox money with no operational risks and no mining costs, and how their cash flows are so predictable. You'll get this full investment thesis for this stock, plus the name of the ticker symbol, of course. If you have any of these reports, it's like having Porter's complete investment philosophy sitting on your desk as a reference guide. And the real world value of this is easily several $1,000s alone. Heck, we sell the bonus reports for $200 each, and we're giving away 3 of our best ones. So let me add up the value of all of this for our listeners. By buying Porter Stansberry's permanent portfolio blueprint for $199 today, you also unlock access to 3 bonus special reports: God's Investment, the Lindy Index, and the Ultimate Gold Stock. That's a total value of $800. So go ahead and click right here or go to porterspermanentportfolio.com for all the information. You'll get all the details, including our 30-day money-back guarantee, so you can examine everything risk-free. Keep in mind that we do subtract a 10% refund processing fee. All right, Porter, before we wrap up this episode, I want to make sure our listeners really understand what's at stake here, because I think some people might be listening to this thinking, well, maybe I'll just wait and see what happens.
Yeah. And to those people, I just want to reiterate what I've been saying throughout this episode. We have inflation that is not going away. We have a government that's been captured by special interests that have no ability to implement any kind of rational financial policy. And we have a citizenry that's been conditioned to believe that the government will always step in and save the day, except for they can't. The math just doesn't work anymore at all.
Porter, so what happens to the person who does nothing?
Well, if just one of the events that I've mentioned happens, your portfolio get cut in half, maybe 75%, and that means your retirement plans are going to just get destroyed. The lifestyle that you've worked decades to build, that's going to shrink dramatically. Legacy, did you want to leave your kids something? It's gone. It's going to vanish practically overnight. And Aaron, I can't tell you, again, when this will happen. It's going to happen soon. And we know it's only a matter of time. But the best thing is, if you set up the permanent portfolio, it doesn't matter when it happens, because you'll have all the protection you need and you can still make great returns. All right? We're not saying go to cash and sit there and hope the market crashes. No, we've got a solution that allows you to continue to build wealth, but will protect you when the drama happens and the panic begins. So this is the solution. Aaron, I've been doing this a long time. I've studied more economics than probably just about anybody else in the world. I've read history since, before high school. And I've been doing finance professionally now for 3 decades. I'm telling you, the permanent portfolio blueprint is the very best thing I've done in my career. It's going to help people stay invested and be protected. This is the culmination of millions of dollars that I've spent on research, decades that I've spent testing these ideas, refining them. Folks, I think this is it. I think the permanent portfolio is the one thing that you really, really should take a look at. Just look at the performance. In its first year, Porter's permanent portfolio is up 25%. We beat the market by a mile, and we did it with half of the risk. That is an incredible performance that I think is unmatched. And whether it's the independent advisory space, ours, or any other hedge fund or any other, asset management you could find anywhere in the world. And I'm giving you the secret to that performance. I'm giving you the entire blueprint today.
Well, it's the difference between having a plan and crossing your fingers.
Yeah, hope isn't a strategy.
And you get everything you see here for just a one-time payment of $199. No subscription, no hidden fees, no ongoing payments, just $199. Plus, with a 30-day money-back guarantee minus a 10% refund processing fee, this is almost entirely risk-free. And look, don't just take our word for it. On the next page, you'll hear from some of our subscribers too.
Folks, please don't put this off. It's going to take you some time to read these reports. It's going to take you some time to reallocate, and you won't be protected until you get that done. So please get this information now, read it as soon as possible, and put it to work for you.
So go ahead and click right here or go to porterspermanentportfolio.com for all the information. You'll get immediate access to everything we covered today. Porter's Permanent Portfolio Blueprint, plus the full guide on P&C insurers, the list of Lindy companies, the ultimate gold stock report, everything. All protected by our 30-day money-back guarantee. Porter, this has been an incredible episode. I mean, the depth of insight you've shared today, the practical solution you've given our listeners. I can't thank you enough for taking the time to walk us through this.
Aaron, it's been my pleasure. I really appreciate being here today, too. It's always a lot of fun working with you.
Folks, this has been an awesome, very special episode of the Porter & Co. Black Label Podcast. I'm Aaron Brabham, joined by the legendary Porter Stansberry. Until next time, take care of yourselves and your wealth.
Thank you for listening to the Porter & Company Black Label Podcast with your hosts, Porter Stansberry and Aaron Brabham. We'll see you soon.